a masterclass, 10 money-saving lessons on student loans, how to overcome a growing debt crisis. By the time you graduate from watching this webinar, you'll have learned some proven tactics for cutting your monthly student loan payments, and possibly even getting some of your balance forgiven. What are the prerequisites for taking this class? Just 2. You're burdened by student loans, and you're willing to take a few minutes to get your financial life back on track. Mortgages are still the largest form of debt in the country, but coming in at number 2 is student loan debt. At more than $1.2 trillion for everyone in this country. That's more than all of the credit card debt we owe, which is just over $1 trillion. Yet, for such a big problem, there's not a lot of talk about a big solution. But first, let's review just how big the problem is. Maybe you've heard it called the student loan crisis. Now, that's not melodramatic, it's accurate. According to Time magazine, more than 40 million Americans are carrying big student loan balances. Of those, nearly 6 million owe more than $50,000, according to the Brookings Institute. And a CNBC report says 1 million of them defaulted on their loans in 2016. Forbearance temporarily stops your payments, with a catch. Here's a concept that's familiar to anyone who's called their credit card company and begged to get a late fee removed. Yes, sometimes just asking works. Your servicer wants you to keep making payments, so sometimes they'll give you a forbearance, which means you can temporarily stop paying your student loans. Basically, it's like a hold button for your loan payments. The thing is, you need a darn good reason for such incredible debt relief. These so-called discretionary forbearances require your servicer's permission. So, if you can't make your payments due to a change in a job, a medical expense, or other financial difficulties, your servicer can decide to give you a forbearance. And then there's mandatory forbearance, which means your servicer can't deny you the forbearance if you qualify. What does it take to qualify? If you're on a medical internship or residency program, or if you're in the National Guard and got activated, or if your payment is more than 20% of your monthly gross income, then you may get a mandatory forbearance. There are many other scenarios, so you need to spend a few minutes conducting your research and plugging in your own particular circumstances. The few minutes you spend could save you thousands of dollars. Whatever forbearance you qualify for, you can get up to 12 months of making no payments. In total, you can get 3 rounds of 12-month forbearances before you max out. That gives you plenty of time to get your financial life in order, but remember, you still owe the loan. In fact, under a forbearance, your interest charges continue to accrue. And because you're not making payments, that means your overall debt load increases. So you get relief now, but later on you'll pay for it. And, of course, the rules are different for private student loans. Still, anything is better than defaulting on your student loans, which is what happens when you don't make payments for 270 days or more. That means your wages can be garnished, your credit score will be negatively affected, and any future tax refunds and other federal benefits can be withheld. Deferment. Temporarily stop your payments and pay no interest. Let's talk about deferments now. As you can already see, student loan jargon can be very particular and difficult. In this instance, a forbearance and a deferment are more similar than different. In fact, the only major difference is that with a deferment, you might not owe that actual accrual of interest we just talked about. Like a forbearance, you must have some serious circumstances that prevent you from making those monthly payments, like, say, a serious illness or a job layoff. Now, this is just a rough overview of forbearance and deferments. For instance, the Federal Student Aid website says, you may be eligible for a deferment on your federal student loan if you are a parent who received a Direct Plus loan or a FFEL Plus loan, while the student for whom you obtained the loan is enrolled at least half-time at an eligible college or career school, and for an additional 6 months after the student ceases to be enrolled at least half-time. Income-based repayment. Now let's talk about the federal government. It offers a myriad of programs that help you cope with your student loan debt. The first is called Income-Based Repayment Program, or IBR. If you have federal student loans and can demonstrate a financial hardship, you qualify. Basically, an IBR matches your monthly payments to your income. It's the government's way of acknowledging that the salary you earn after you get a degree usually doesn't exactly match the expense you incurred to get it. For example, the program adjusts the monthly payments for your federal direct student loan debt to your income and family size. If you have lower income and a larger family, it reduces your student loan payment requirement. In general, enrollees spend between 10 to 15% of their take-home pay to repay student loans under IBR. This reduces the burden of student loan repayments on your budget. But the government acknowledges that this can increase total cost over the life of your loans. Still, it helps you greatly in the short term. Income contingent repayment. Just to make these programs extra confusing, there's also one called Income Contingent Repayment Plan. The ICR is a little different than the IBR. While both adjust your monthly payments based on your income, the ICR has a few important differences. First, you don't need to show any crushing financial problems to qualify. On the downside, unlike IBR, ICR doesn't stop your monthly payments from increasing indefinitely along with your income. So, how do you choose between them? We'll answer that a little later, because we're not even halfway through the complex options you have available to you. Like I said earlier, once we've gone through all the options, we'll show you an easy way to navigate the process. Pay as you earn. There's a third federal student loan relief program that matches monthly payments to your income. It's called Pay as you earn. It's even better than IBR at reducing monthly payments. It was updated and expanded a few years ago into yet another option called REPAYE, which stands for Revised Pay as you Earn. But the concepts are still the same. Your monthly payments are reduced to 10% of your discretionary income, and after 20 or 25 years, whatever balance is left is forgiven and forgotten. You pay nothing more. What's the difference between these two? They're subtle but real. For instance, to qualify for payee, you must have a partial financial hardship. For repayee, anyone with qualifying student loans are eligible. Your spouse's income doesn't count in payee if you file separately, but it does in repayee. What's the difference between the two? They're subtle but real. For instance, to qualify for payee, you must have partial financial hardship. For repayee, anyone with qualifying student loans are eligible. Your spouse's income doesn't count in payee if you file separately, but it does in repayee. What does this all mean? Generally speaking, payee is a better option for married borrowers when both spouses have an income. Repayee is usually better for a single borrower and people who don't qualify for payee. In both cases, just like in ICR, if you get a new high-paying job or a big raise, your payments jump up along with that extra income. If you want to see payee or repayee is right for you, we recommend that you visit studentaid.gov. There are so many variables, we could do an entire presentation on just that. Federal District Consolidation Loan. If you've ever used a consolidation loan to take care of credit card debt, you might think you understand how a federal district consolidation loan works for student loan debt. But you'd be wrong. You'd use a federal direct consolidation to consolidate federal student loan debt into one easy payment. But the loan structure, interest rate, and how to qualify varies greatly from other types of consolidation loans. Consolidating debt is generally done to simplify debt repayment. If you have multiple individual debts to repay, it can get complicated to juggle all of those bills within your budget. Consolidation reduces that down to just one bill, so debt is easier to manage. However, that's not the only advantage of federal direct consolidation loans. In this case, taking out this type of loan provides an additional benefit that can be significant, depending upon your situation. Namely, you can make defaulted federal student loan debt current. It's an amazing benefit and one worthy of a few minutes of your research. Applying is easy, and you do it through the federal website, studentloan.gov. If you don't want to deal with forbearances and deferments, and you're not interested in the federal relief programs we just talked about, you have another option: refinancing your loans on your own. When you refinance, you actually take out a new loan at a lower interest rate. This works best if you're not cash-strapped and want to pay off your loans faster. That's because you don't need a high credit score to qualify. Basically, you're consolidating your federal student loans into one private loan for a lower interest rate. You can then plow your savings back into paying off the principal. Here are 5 steps you need to take, starting with the simple step of figuring out how much you want to refinance. Determine how much debt you need to refinance. Note current balance and APR in each loan you include. Shop around to get quotes from lenders. Apply for the loan. And authorize the lender to run a credit check, which creates a hard inquiry on your credit report. Then you need to record the balance and APR of those loans so you can shop for a better deal. But remember, when you apply for a new loan that results in a hard inquiry on your credit report, that can temporarily drop your credit score. It's not a huge deal, but it's worth mentioning, because if you want to apply for too many loans in too short of time, your score might go down. So for instance, you don't want to refinance all your student loans at the same time you apply for a new credit card or secure a new auto loan. All those inquiries, not to mention the new credit, could drop your score and raise your rates. Student loan forgiveness. Now we get to the most enticing but most complicated part of this masterclass on student loans. Can you really get your hefty student loan balances forgiven? The answer is yes, but the Public Service Loan Forgiveness Program, PSLF for short, provides a path to federal student loan forgiveness. If you work in a qualified public service profession, and that includes many in the medical profession, the government might forgive a portion of your federal student loans. However, the qualification process is long, complicated, and worst of all, it's not guaranteed. And you need to make 120 regular qualified payments first. That's 10 years of payments. But if you do qualify, you could get out of student loan debt for less than you originally borrowed. Questions to consider. Is it worth the hassle? Do you qualify for another relief program? Do you work in a qualified profession? Remember when we were talking about those federal relief programs like IBR and REPAYE and how they lower your monthly payments, matching them to your income and family size? Well, we also mentioned that they can cost you more in the long run because they increase the repayment term for up to 25 years. 2.5 decades in debt is a long time. So the fact that PSLF forgives your balance after 10 years is a huge advantage. Here's one of the catches, though. To qualify, you must first enroll in a federal relief program like IBR, ICR, or REPAYE, and you must recertify your income every year to remain eligible. Finally, you can only take advantage of this program if you work in certain professions that the federal government deems a significant contribution to our society. Luckily, that includes nurses and doctors, and it also includes firefighters, police officers, and teachers. And there's a separate but similar program for military veterans. Getting help fast. As you can see, this stuff can get complicated enough to fluster a PhD. It's one big reason that the Government Accountability Office told Congress that 51% of all federal direct loan borrowers were eligible for the IBR program we mentioned earlier, yet only 13% are actually participating in it. And the Department of Education even admits that their efforts to increase awareness about these federal relief programs is incomplete and inconsistent. That's why you might consider hiring a professional. Think of it like your taxes. If your income tax becomes too complex, you can hire a CPA or a tax preparer who not only saves you the time and aggravation, but also can find ways to save you money. Hopefully more than enough to cover the cost of hiring them in the first place. That's been happening more and more in the student loan world. Now let's talk about what to look for in a student loan expert. Long work history, excellent online reviews, an A+ rating with the Better Business Bureau, and recommendations. Student loan scams. With this much money on the line, some bad actors are bound to come after you. While new scams pop up all the time, let's review the big ones, which are also thankfully the easiest to spot. Let's begin with the advanced fee scam. This happens when one of those agencies we talked about insists you pay a small upfront fee. This can be up to $1,000. Unless that money is being held in escrow, you shouldn't pay money first to save you money later. A legitimate third-party company doesn't charge you until they start working for you and get results. The thing is, you can do that on your own for free at studentloans.gov. If you want someone to do this for you, you can certainly pay for the service. But if the company doesn't tell you upfront about the do-it-yourself option, they're not being ethical. Finally, a lawyer, or someone who claims to be a lawyer, says they can settle your student loan debt for pennies on the dollar. All you have to do is send in your student loan payment to them instead of your servicer. The law firm will negotiate with your servicer and reduce what you owe. Except the law firm never makes a payment, keeps your money, and you go into default because your servicer hasn't heard from you. In the worst case, the law firm actually comes back and offers to negotiate with your servicer to get you out of a default. Anyone want to guess if they actually do that? If you take nothing else away from this webinar, learn this. Stick to the third-party resources who have a long history, excellent reviews, and an A+ rating with the Better Business Bureau. Private student loan help. So far, almost everything we've discussed has involved federal student loans. There's a good reason for that. Federal loans represent around 94% of all student loans. Private loans are only a fraction. So what is a private student loan? Simple. You go to your bank or other private lender and secure a student loan just like you would an auto loan. Because these go through private financial institutions that face competition, their customer service is often better than some of the horror stories you read about federal student loan servicers. Then again, you're not eligible for those federal relief programs. Your options are pretty much to throw yourself in the mercy of your lenders, or consolidate your loans like we talked about a few minutes ago. Many Americans with private student loans also have federal student loans. They took out the private student loans to cover what the federal loans couldn't. Some general advice. When you apply for forbearances, deferments, or federal relief programs, your credit score isn't being affected. However, if you try to refinance your loans on your own, your score can be affected. The most common mistake is applying for multiple refi loans instead of just asking for quotes. Every time you apply, it triggers a hard inquiry, which drops your score a little. Don't let all this information depress or discourage you. Yes, it can feel like your head will explode from all of the rules and options, but you have help, both free and paid. The bottom line is, the programs and advice we discussed today can greatly enhance your bottom line. Congratulations! Now that you've graduated from our Money Saving Student Loan Masterclass. Let's recap the most important lessons. First, you never want to default on your student loans because your wages could be garnished. Second, a few minutes of research on your part can save you not only from default, but also can save you thousands of dollars. Third, your options include forbearance, deferment, income-based repayment, income contingent repayment, pay-as-you-earn, federal loan consolidation, refinancing, and in some cases, even loan forgiveness. If you have private student loans, you have fewer options, but you can still get help. The bottom line is, if you can't put the time in to figure out which option is best for you, maybe consult a reputable professional who can save you much more than they'll charge you. Whatever you do, don't do nothing. Take action.